So we continue with economics chapter 14, right? Contestability. When we talk about contestability, we're simply talking about a contestable market. But before we go in deep about a contestable market, what is the theory about contestable market and neoclassical theory? So for contestable market theory, it only says that firms in a contestable market, firms have access to technology and equal information, which makes it easy for them to lower price and get attracted to that market. So the theory of contestability states that in as much as there's low barriers to entry and there's accessibility to technology, firms will be forced to be efficient. That is contestable theory in a contestable market. Then for the neoclassical theory, they believe that firms become only efficient based on the influence of demand and supply. So get the difference here. The contestable market theory versus neoclassical theory is talking about the efficiency in the market. The efficiency in the market comes as a result of, for the contestable market, it comes because there is accessibility to equal technology and low barriers to entry. But according to the neoclassical theory, they believe that there's efficiency based on the influence of the market forces of demand and supply. I think it's clear. Okay, great. So that takes us to a contestable market. So why is it a contestable market? We call it a contestable market because it's a market where the threat of new entrants, rather than the number of existing firms, keep prices low and quality high. So it's a contestable market because in this market, the fear of new entrants, potential entrants, keeps prices low. And if prices has to be low, it simply means that firms in that contestable market have to be what? Have to be efficient. So that means prices will be low and quality will be high. Do you understand what a contestable market is here?
Yeah.
Any question about that?
No.
Okay. So that takes us to the characteristics of a contestable market. The first characteristic of a contestable market is that the numbers of firms vary, but none of them have significant share of the market. In a contestable market, none of the firms in that market have the ability to have a market power, because most of the time there's free entry and exit, which simply means existing firms in that market would always be wary of what new entrants could bring. So that means no one has a significant market share. We all contest together. That means free entry, exit. Two, freedom of entry and exit from the market. That means firms can easily enter and leave the market without significant cost or obstacles. So in the contestable market, because there's free entry and exit, it simply means that no matter how much you spend, it's easy for you because it's going to be a very low cost. So it means the cost of entry and the cost of exiting is less. So it means you can come in and go out at any point in time. The third one, there's no collusion as firms compete with each other using lower prices in the contestable market. Because the word contestable means we can compete. So which simply means that we don't collude. We are rivals. So we try to set our price as low as possible. There's no collusion in the contestable market. That's another characteristic. The fourth one, absence of sunk cost. When we talk about sunk cost, we're talking about costs that cannot be recovered. Yes or no? So investment made in the market are not lost if firms exit, making it easier to leave. So the exit of a firm in that market is easier because the sunk cost is not significant. Do you understand that?
Yeah.
That's another characteristic. The next one, firms are short profit maximizer. That means they produce where the marginal cost equals to the marginal revenue. So in the short run, they are profit maximizer. But because in the short run, they can make supernormal profit, that attracts potential firms into that market. Do you get it? So in the long run, firms will only make normal profit. Clear, right?
Yeah.
The next one, firms may produce homogeneous products, or they may produce branded goods for product differentiation. So they might produce branded goods because they are contesting. It's a contestable market, which simply means they might produce the same product, but they find a way to differentiate their product from those of the competitors. Is it clear? The next one, there's perfect knowledge in the industry. All participants have access to the same information about price and the market conditions. So that means there's a perfect knowledge in a contestable market. And the last one, the potential for eat and run competition exists. So when we talk about eat and run competition, we're simply talking about firms that understand that there's supernormal profit being made. So they quickly come into the market to make supernormal profit. And as soon as the profit starts declining, they exit the market. That is what we call hit and run competition. Do you get hit and run here? So I wrote, the potential for hit and run competition exists. Hit and run competition refers to a market entry strategy where firms temporarily enter a market, quickly capture supernormal profits, and then exit when those profits diminished. Do you understand? So we call them hit and run competitors because they are attracted to only the supernormal profit. And as soon as they are attracted to the supernormal profit, when new firms come in, supply increases. And as soon as supply increases, firms would not be able to sell or to produce where MC equals to MR. They would rather produce where MC equals to AC, where D equals to AR. That means they cannot make supernormal profit. Rather, they will make normal profit. And as soon as this normal profit starts diminishing, they exit the market. So these are the characteristics of a contestable market. Any question about that? Yeah. So that takes us to the implications of contestable markets for the behavior. Sorry. Yeah, isn't there? Implication also, okay. No, I think I'm missing something there. Let me see. Oh, yeah. We didn't talk about how contestable markets. Sorry. We need to talk about how the last characteristics here. Okay. So now, how contestability impacts market behavior. So there are three ways in which contestability can impact market behavior based on price competition, efficiency, and innovation. So we're going to start with price competition. For price competition, because it's a contestable market, it means there's free entry and exit. How will firms get attracted? Firms get attracted because they are making supernormal profit. So what do the existing firms do? The threat of new entrants can drive down prices as existing firms try to deter new competition. So existing firms would not want to charge a higher price so that new firms cannot be attracted. Because when you charge a higher price, it means you might be able to make supernormal profit. But because new firms will be attracted, existing firms might not want to charge a higher price. So that is what price competition is about there. Do you get that? Yeah. To increase the efficiency. Firms may become more efficient in production and resources to lower costs and remain competitive in the contestable market, because every firm in that market contests. Every firm is our competitors. It simply means you should find a way to reduce your cost in terms of resources, in terms of output. So efficiency is important in a contestable market. And the last one, innovation. So the need to stay ahead of your potential entrant, or the need to stay ahead of your competitors will mean that you have to start trying to produce goods or services that are new, that would make your customers stick with your product. If not, then they will go to your competitors. So these are how contestable markets impact market behavior. Is it clear? So that takes us to the implications now. The implications of contestable market for the behavior of firms on profitability and pricing decision. Are you there? Yeah. Okay. So for the implications of contestable market for the behavior of firms in terms of profitability and pricing. So we start with profitability. I wrote, supernormal profit is achievable in the short run, but in the long run, only normal profit can be earned. Supernormal profit, it attracts new firms, which in turn increase supply and bring down prices to the point where only normal profit is being made. Assuming that a monopolist is the established firm in an industry, if it charges prices which lead to earning supernormal profits, then another firm may enter the industry charging lower prices. The new firm will remain so long as the existing firm is earning supernormal profit, taking market share away from it and reducing its overall profits. So this simply means that the ability of a firm to earn supernormal profit is dependent on the barriers to entry and exit to the industry, not the number of firms in the industry. So thus, in a contestable market, hit and run firms are the reasons that in the long run, normal profit can only be earned. So the profitability in a contestable market. In the short run, firms in the contestable market will make supernormal profit. But in the long run, they seem to make what? A normal profit. Why? In the short run, there's supernormal profit, which attracts new entrants. So let's assume that we have a monopolist that's been charging a higher price to make a supernormal profit. Because there's free entry and exit, a new firm will be able to come into that market to contest with that monopolist. And coming into that market means it's going to charge a lower price. Charging a lower price, the monopolist would not have any other choice than to reduce its price too. So the new entrants, the new firm will be there so long as the monopolists continue to make supernormal profit, to the extent that it starts taking the customers from the monopolist. Taking the customers from the monopolist means that the monopoly would not have any other choice than to reduce its prices. So reducing the prices means both the new entrant and the monopolist will start selling where MC equals to AC. And at that point in time, they won't be able to make supernormal profit. Rather, they will make what? Normal profit. So if the new entrant is an eat and run competitor, as soon as the supernormal profit has declined to normal profit, it leaves the market, yes or no? Leaving the market would allow the monopolist to charge a higher price again, isn't it? But the problem about a contestable market is that as soon as the eat and run leaves the market, if a monopolist chooses to charge a higher price again to make supernormal profit, another new potential competitor will come in. So which simply means in a contestable market, you can never charge a higher price to make supernormal profit. That is why in a contestable market, it is always going to be normal profit in the long run. They are eat and run. They just want to come to make supernormal profit and leave. But every now and then, they leave, new ones will come in to contest with that monopolist, which might not be able to leave based on the fact that it has a sunk cost. Do you understand? Yeah. So that is profitability in a contestable market. Profitability in a contestable market allows us to know that, makes us to know that in the short run, we are able to make supernormal profit, and in the long run, we tend to make what? A normal profit, based on the fact that there's always going to be hit and run competitors. Clear? Yeah. Any questions about that? Yeah. So that takes us to the graph analysis. So for the graph analysis here, in figure, so the graph analysis here in figure 1, are you there? Yeah. So for the profit maximize, a monopolist will charge where MC equals to MR. This is where the monopolist will charge at a price of P and the quantity of Q. This allows it to make supernormal profit at this shaded point. Do you get the point here? We start with a monopolist. So a profit maximizing monopolist will charge a price at P, produce at output where MC equals to MR at Q. Do you get it here? Yeah. So that means a monopolist will be able to make supernormal profit at this point. But because it's a contestable market, new firms will come into that market. And as soon as new firm comes into that market, what happens to price? Price falls from P to P1. And at that point in time, firms in that market will charge at a price where MC equals to AC, not where MC equals to MC anymore. MC equals to MR. They charge at MC equals to AC, where the quantity will be what? At Q1. And the price will fall at P1. So at this point, where MC equals to AC and AR equals to D, you cannot make a supernormal profit. Rather, you make what? A normal profit. Is it clear now, please? Yeah. So in a contestable market, we assume that the market was a monopolist. It's a monopolist market. So because it's a monopoly, there's supernormal profit that attracts new firms to come into that market. Based on the fact that it's a contestable market, which has weak barriers to entry and exit, it allows new firms to come in. Then the demand will shift rightward from MR to D, AR. So at that point in time, price will fall from P to P1, making it difficult for firms in that market to make supernormal profit. Rather, they will make what? A normal profit. And where we have a normal profit is where MC equals to AC equals to D equals to AR. This is normal profit. Is it clear? Mm-hmm. Any question about that? Mm-hmm. Good. So we have the pricing decision now. Are you there? Are you there, please? Yeah. So for pricing decision, firms in a contestable market may choose to set lower prices than they would charge if they have to maximize their short-term profit. So it's about price. Price in a contestable market, because they are competing with price, it is difficult for them to charge a higher price. When they charge higher prices, based on that, the fact that supply would increase, it is difficult to charge a higher price. So there's no supernormal profit because price are set at a low rate. Then we have, so the reason they do this to keep new entrants out of the market, as potential firms may not be attracted to normal profit. If they continue to make a normal profit, no firms will want to come into that market. Normal profit will not attract firms, especially eat and run firms. It's only supernormal profit that attracts them. I think it's clear. Then entry to and exit from the industry. It is considered a contestable market because the barriers to entry and exit are weak. Basically, the exit costs are low. So if the exit costs are low, it is easier for firms to come into the market. I think it's clear. Yeah. Then the last implication is on the significance of the sunk cost. We already know what the sunk cost is, the fixed cost that is not recoverable. So the fixed cost of a production which cannot be recovered might make it difficult for firms to be attracted to a market. However, if the sunk costs are low, then the firms has lost little by entering or then leaving the industry. So the point about the sunk cost is for new firms like eat and run firms, eat and run competitors coming into that market, if the sunk cost, the cost that they cannot recover is high, they won't be attracted to that market. But if the cost, for example, advertising or equipment costs are cheaper that they can easily even sell if they want to leave the market, if it is cheap for them to come into the market, that means the sunk cost is cheaper. So it means they would lose nothing entering and exiting the industry or the market. So these are the implications, or these are the reasons why we could have a contestable market. So if a contestable market is going to be in existence, it simply means that the significance of the cost, the sunk cost is less, the profitability there is high, and the pricing strategy is lower. So all these things are the reasons why we have a contestable market. Without them, there's no contestable market. And the principle about contestable market starts with a monopolist. Is it clear? Yes. Any question about it? Yeah. So in the next class, we're going to talk about the cost and benefits of contestability.